Welcome to Consumer Lending Perspectives, a podcast where we talk to financial industry leaders about trends in consumer assets, underwriting, performance, customer acquisition, fraud prevention, liquidity, and more. Hosted by Jeff Bogan, CFO at Upgrade and FinTech veteran. This show delivers key insights on the topics that matter most to financial executives.
Welcome to Consumer Lending Perspectives Podcast, brought to you by Upgrade, a fintech company that offers affordable and responsible credit, mobile banking, and payment products to mainstream consumers. I'm your host, Jeff Bogan, the CFO of Upgrade. Today, we have the perfect guest, Dr. Joe Breeden, who has been designing and deploying risk management systems for loan portfolios since 1996. His expertise includes scoring, forecasting, stress testing, and economic capital models for banks and credit unions. Let's get going.
Thank you, Jeff. Thanks for having me.
We're glad to have you.
You can call me Joe.
All right. So, Joe, the post-pandemic period has been challenging in consumer lending. Loss rates have been much worse than expected across pretty much all loan types. What are some of the reasons for this phenomenon?
Well, the pandemic is, of course, a unique event, and I tend to think of it like a big hammer that rung the bell of the economy. If you think about that swinging bell, things have been happening much faster than a normal economic cycle. And in response to these unexpected swings, the government made unprecedented assistance programs to borrowers, to all consumers. Lenders put forbearance programs in place, all to a degree we haven't seen in our recorded data. So this obviously had quite an impact in some unexpected ways. It made things look artificially good in the beginning. Our models said, hey, you should be having high losses right now because unemployment rates are through the roof and GDP is crashing. And it's like, but no, instead we've got low loss rates because of all this assistance. Well, that doesn't mean you won't have losses in the future. And so that had repercussions. One of those is what we call score inflation, that especially for low-income borrowers, all that extra cash gave them a chance to pay off some bills, make themselves look better, all the stuff you're supposed to do to improve your bureau score. But the question is, did it really change behavior? What we saw is that when those folks came back to get a loan, those bureau scores were inflated, that they hadn't actually changed behavior that much. So we had to deal with that. We had the low score tier was actually much lower score than we thought, and that factored into delinquency and loss rates in 21, 22. But then you had continuing changes in the economy. You had the sudden spike in inflation, and the Fed reacted to that by raising interest rates. And then when interest rates shot up, well, that changed consumer behavior again. The consumers who didn't desperately need a loan could step back and say, well, maybe I'll wait. And so we saw this second effect, which we call macroeconomic adverse selection. You know, it's for academic journals. It's a big phrase, right? But
can you give us an example of one? Like, give us an example of this adverse selection you're talking about.
You know, I've been studying this for over a decade. Basically, periods of time or situations where your credit scores don't reflect the credit quality you get through the door. I always say that a credit score gives you the ability to select the best of the applicants. But if there are no good applicants, you can't make good loans out of them. You know, picking from whoever's best doesn't mean they'll be good. So an example of that, the first I saw, maybe 15, almost 20 years ago, was working with a lender in Minnesota, loans. And as I analyzed the data, this residual risk relative to what the model would predict was cyclical. Every December, we saw really good quality loans. And every end of May, June, July, we saw really poor quality loans. And we thought about this a while and talked to them about it. If you think for a moment, well, in December, in Minnesota, before you had any online shopping, that means you're standing on a frozen auto lot negotiating with a dealer. You got to sweep the snow and ice off the car to even see what you're buying. Why would you do that? Well, you're doing that to get the best deal because you know he's going to have to pay taxes on his inventory at the end of the month, and he's not making a lot of sales. So it's classic buying opportunity. But then in late May, June, early July, the cars are shiny, the weather's nice, the balloons are flying. Well, the guy who sees that and thinks, gee, I think I'll check out some cars, that is a fundamentally different person. And it shows in their performance, but it does not show in their bureau score. You get this dichotomy at every score break. And in fact, the difference is most dramatic at the highest scores. So that was quite an education. Um, the, uh, the other shorter version is just dinner party conversation. If you think of gathering with friends, I was having dinner with my sister 2 years ago now, and she was saying how, they didn't like where they were living. She wanted to look at getting a new home, move to a different area. She gave all the reasons why. Her husband, my brother-in-law, CFO for a box making company. And I looked at him and was like, John, you're not going to buy a home now, not at these rates. He's like, no way. We're going to wait. Okay, that is a value shopper. In both
Yep.
cases, you've got a clear break: value shopper and impulse buyer.
Right. So how have you seen that manifest itself the last 18 months then in terms of who is applying for credit today amongst your clients?
Well, we had seen some of this before. You've got these anecdotes, but when we looked back at prior events, really my education about this quantitatively was in 2006, 7, and 8. In 2006, early on, we got 4 large subprime mortgage lenders as clients. And we set up vintage models and we started doing this tracking, and it jumped out to us that quality was deteriorating rapidly in 06, 07. The Big Short is a great movie, and it talks about all these anomalous bad behaviors that were going on, all the bad loans, but systematically there was something else happening, which is that in a rising rate environment where the economy doesn't look so steady, the good shoppers stepped out, left the risky borrowers, and that's a bad time to grow
Sounds
volume.
familiar.
And so yeah, so that's exactly right. So we saw that in mortgage, and we saw a little bit of that in auto at that time, and we thought there must be something going on here. We did a research project with a Philly Fed, and a researcher there that we published several years later. And what we found was that the best correlation was to change in interest rates, change in loan demand. That basically, when the demand falls, that you're not losing it randomly, you're not losing demand uniformly across all kinds of people. You're losing a specific group, which are those value shoppers. So that's what we came into this having seen before. Now, that gave us a certain amount of intuition, and I started talking to folks about, gee, I wouldn't be doing a lot of mortgage or auto lending back in 2021. As we were paying close attention this time and gathering better data, we did see that this is a much more systematic effect across many loan types. It was even a bigger deal than we thought based on what we experienced in the global financial crisis.
It sounds like your clients should have listened to you back in 21, considering what we were about to enter into.
Well, in the auto lending space, I have had a couple people come back to me after a certain conference presentation and say, gee, we really should have listened to what you said.
Well, so let's talk about industry data. So, what do you look at today to monitor and predict trends in consumer credit? And what do your clients look at?
Well, the irony here is that I'm a model developer, right? I'm originally a physicist. I'm all about data and making models. And yet my message today is intuition. Put yourself in the mind of the borrower. Ask the question, why do you want a loan now? If you want all good answers to that question, when you have some negative questions, some negative answers of, it's not a very good time to borrow money. Do you really need it now? It's kind of old school lending, but as a judgment on top of the models, I think that's where we have to be. And so that's why in 21, I'm looking at rates and I'm thinking, well, I don't want a car or a mortgage at these rates. So why would you? So anyway, that's one. But so what do you do with that? What do you do with that intuition? Well, I bring that up to say, then think about metrics that are going to inform that. So obviously interest rates, some of the economy, but we can also look at loan demand. Basically, if demand is falling, don't assume it's uniform. Assume that you lose the best people first. And there's a survey called the Senior Loan Officer Opinion Survey that asks two questions. And I love this. The first question is, are you loosening or tightening lending standards? And that gets reported everywhere in the news. People talk about lending standards. In our experience, that has zero correlation to loan quality.
Interesting.
Because, yeah, that survey is about your selection of borrowers. But if they're no good borrowers, you can't select good ones no matter what your policies. So the second question on that survey is the one I care about. And it's, how has loan demand from consumers changed, or commercial loan demand from businesses? That turns out to be highly predictive. So
interesting. So you need to be part psychologist and part data science to be a good consumer credit lender.
I would say so. Yeah. And in fact, I have to point out that before I got into lending, I actually worked for about 4 years in Las Vegas, helping predict the outcome of
that's a perfect
sporting
job
events.
for this then, given what you're saying is a highly predictive of credit.
It's a lot of the same dynamic. You start with a model, and then you've got the judgmental overlay of player attitude, team attitude. Some of the best gamblers in Vegas are former coaches, because they've got analysts like me working for them, and then they have the psychology of the team, and they combine.
So how did this dynamic translate into personal loan performance for your clients?
Well, I have to say, I mean, it seemed obvious in mortgage and auto. In 2006, I wasn't really paying attention to personal loans, so I didn't have any history to draw on. This is a once-a-decade event. As a data scientist, that's unfortunate. We need
and
data.
then personal loans sort of fell out of favor
so
the last 30 years up until 2010, 2011, when they started coming back, right?
Right. It's grown dramatically. So we really didn't have the history to look at. We did look at credit card back in 2006, and if the impact to mortgage was a 1, the impact to auto was 50% of that. The impact to credit card had been about 20% of that. That's what we saw before. This time, it's kind of everybody's hit. There was no safe product. And so, to your question about personal loan, yeah, I was surprised to see that it was also bad in personal loan, that this adverse selection effect due to borrower appetite.
Yeah, and that you think that basically
for
supports your
personal loans,
argument that adverse selection is really the main driver of this, and that's something that hit all asset classes this time around. How do you think it was different in 2008 then, where mortgage obviously was hit much harder, auto to a much lesser extent? What drove those differences?
Well, fortunately, we're not sitting on a real estate asset bubble right now. We think, prices did go up fast, but they've kind of settled there. And we don't have a full-on recession, although there are some doubts about whether the employment numbers are actually correct. So we may be having a small recession without knowing it. But it's the other side is doing okay. So yeah, loan quality is not what we want. It may be improving. We can talk about that, but the economy at least is holding more or less steady. So if we had both together, then we'd be having a second crisis as a quick follow on to the pandemic. And I'm glad we're not.
Yeah. So say more about the unemployment rate. Why do you say that that's a little harder?
Well, this is something I've just started seeing some economists come out and talk about, literally just in the last couple of weeks. Unemployment is surprisingly hard to measure employment. And a big part of their models is based on, a big part of the number is based on a model that predicts employment levels among small business. They don't have real-time data of small business employment. They're basically predicting, given other economic factors, should small businesses be growing or shrinking? And some economists have looked at that part of the number and said that doesn't line up. What we are seeing suggests that small business, is actually contracting, that there is a net rate of failure. And so if you net out that part and look just at what's left in the economy that is more solidly reported, it's either neutral or falling. So unemployment may be slightly higher than we think. Employment is probably not growing as fast as we thought, may not be growing at all. So we're probably sputtering a bit. And this is this is a similar problem to what we had in the pandemic. A lot of the government data was unreliable. We all talk about how peak unemployment in the pandemic was 14.6, according to official numbers. That's repeated 100 times, except it's not. The Bureau of Labor Statistics, as soon as they released that number, said, but we know that's wrong because we couldn't do the survey the right way. We don't like to fake the number, change the number. So we'll leave it at that. But honestly, we think it's more like 20. So our data is often questionable. And I think we're in another one of those
So
periods.
interesting. So in light of that, if you're an asset manager that invests in consumer loans, securities, what would you take into consideration to kind of understand the macro environment, but also this adverse selection dynamic that's played out over the last 18 months in various consumer asset classes?
We've seen data on this adverse selection effect, at least in mortgage, back through 3, 4 economic cycles. And without fail, the best loans are booked in the recession. Because if you're in a recession and you verify employment or income of some sort, then you've got somebody good. So on the one hand, a recession or a sense that the Fed can lower rates a little bit, that's going to bring better borrowers back. You can verify their employment. You can book better loans in that situation. Now, the existing book might have to deal with, I'm not calling a major recession here. I'm just saying the economy is probably sputtering along. And so the existing book will have to deal with that, but the new book can be quite good. And what always happens is the Fed reacts, lowers rates, the economy improves, and so you'll wind up with the best loans booked today playing out in the best economy over the next couple of years.
Right. So your main point is if you invest in a loan today, that person has a job today because that lender verified employment and they already have a tighter credit policy, probably raised rates, and you're likely going to get kind of the best performance. So it's a little counter-cyclical in terms of the timing of
Yeah.
investing in
So
loans.
as I've talked to our clients over the last 6 months, there's this macroeconomic adverse selection I talked about where the good borrowers drop out of the market. Well, there's a fatigue factor on that. We've seen that after about 24 months, they say, I actually do need a better car. I actually do want to get that house, and I've waited long enough, and rates aren't going to fall. And so they come back, and you start to see a mellowing of the credit quality. And I think we've already been seeing that. We've got a number of clients where you can point to a steady 6 to 12 months of gradual improvement. And so our predictive models, so this is a change. We actually looked at, can we predict adverse selection? And this is our first round of such models, but looks pretty good. And what they suggest is if the Fed keeps rates steady or a little bit declining through the end of the year, we'll be back to average credit sometime during this year. And next year could be great credit. And so, yes, what I'm telling lenders is if you've pulled out of the market, you need to start oiling the wheels. Get ready to come back. Start testing it. Think about your segmentation. Don't just sit and wait because, as usual, you'll wait too long.
Yeah, it sounds like consumer psychology needs a period of time to kind of reset expectations. And your point of view is that those expectations have been reset. People realize we're going to be in a higher interest rate environment. The good borrowers are going to come back, and they are coming back, and you're seeing that in your
That's
models.
exactly right.
Yeah. Okay. Well, I know you work with quite a few financial institutions, and you do a lot of things, help them with credit problems, scoring methods, stress testing, yield forecasting, pricing optimization, a lot of very complicated analytical items. I also know you're coming out with a book this summer, which we're excited to get. It's going to be called Redesigning Credit Risk Modeling to Achieve Profit and Volatility Targets. It's a mouthful, but I better get an advance copy of that book before it comes out. What should consumer lenders be focused on right now? I mean, you've got the data, you've got the book, you've got the insights. What should people be doing right now in the market that we're
Well,
in?
job number one is performance monitoring. Um, I think you can measure the sophistication of a lender just based on how proactive their credit risk assessment is. Um, if you wait to see your delinquency and loss rates fall for your total portfolio, that blended effect takes years to play out. Those are the folks who wait too long. If you're tracking this by origination pool, by vintage, and comparing to a baseline vintage and saying, now I'm starting to see things move back towards baseline and I can run my yield projections. And this is a big part of the book is that everything should look forward to what is my yield and what's the volatility in that yield. And as we bring this residual risk back into line, we ought to see an improvement in those yields. And if the yields look good enough, you can start doing more lending. And as you said, rates are higher right now. So that trigger point is more about yield than it is credit risk. And you want to look at that all but as segmented as you can so that you can figure out where are my pockets of opportunity and go for that.
How do you know when to pick the baseline vintage? Like what is the baseline vintage if you're a chief credit officer at a financial institution? What
Well,
does
it
that mean?
probably means, if you've got a yield target, um, what data did you base that on? Most of the people I talk to say, I'm really set up right now for a 2018, 2019 environment. Okay, well, let's analyze the data, make that the baseline, and see how far you are above or below that. And in fact, most of the credit risk measures that I'm looking at, not mortgage, but most of the rest, are headed back towards that 2018, 2019 level. So that's not bad.
Yeah. What about underwriting changes? Like you've got a lot of clients out there. What are you seeing in terms of underwriting changes today for the various asset classes that you analyze?
Well, everyone talks about machine learning and sometimes alternate data. And there are a few things that I think get lost in the hype. Um, for one thing, if you're applying those sophisticated algorithms to the same data, machine learning applied to bureau data, you really get the same answer. That's not where you're going to get dramatic lift. And in fact, this adverse selection we're talking about, we did a paper, a research project where we compared the best models we could get, machine learning, neural net, traditional logistic regression, panel models, survival models. They all had the same adverse selection. That residual risk is not about the model, it's about the data. So if you're looking at alternate data, well, a lot of folks look at consumer deposits, consumer cash flows as alternate data. Um, I'm not sure how alternate that is. That seems pretty core to our business. So that I encourage anything you can do to look at that. Beyond that, what really matters to me is that I do think in the future people will start to find data sets where we can predict this adverse selection effect at the borrower level based on alternate data. But we have to be careful about it. Uh, there's a Chinese research group that did a paper a couple of years ago where they used tracking data from people's web browsers to see if they went to a price comparison site before buying something, and it was a buy now pay later situation. So they would say, okay, then they're a better credit risk for this real-time loan offer. Now I don't see us doing that. I don't want anything to do with a web tracker. But there may be data that's legitimate to use for this one purpose of understanding the financial savvy of the borrower, the impulsiveness. Um, so we need this other dimension. And I think that's where I hope people will look.
Yeah, hopefully there is more and better data that we can use to do that. Um, Besides hiring deep future analytics to help with kind of estimating macroeconomic sort of adverse selection, is there anything else? Like, what specifically do you think banks and credit unions and other lenders should be looking to? You mentioned
Mhm.
that survey with consumer demand. Are there other kind of indicators of that your clients and others should be looking towards?
Yeah, there is that survey. A lot of folks have a sense of demand, just from their own business. And as demand changes, you want to ask why. Sometimes increased demand is good. Uh, there can be situations where increased demand is being out of market, that the product isn't quite right. So, um, any significant change in demand is worth exploring. The credit quality being as dynamic and monitoring that as you can. So, there's certain on us analysis. In the economy, you've got that SLOOS survey, Senior Loan Officer Opinion Survey, and obviously interest rates, but it's as you get to personal loans and credit card, we see it's more than just interest rates. It's kind of the broader economy. As the economy looks better, people get more comfortable about new
Yeah.
borrowing.
And on the economy, I mean, like you mentioned, the unemployment rate might be a little, well, not inaccurate, but just not representative of what's going on in the small business sector. Like, what do you think is the most important data that your clients should be looking towards with regard to the economy and what expectations are?
Well, normally I would say look at things like unemployment. Um, and, we have to be aware of those caveats. Um, the data is imperfect, but I'm not sure there. During the pandemic, we looked at a lot of alternate data to get an idea of consumer health, and so it may get to be more product specific. Some of the buying patterns, spending patterns, some of the consumer demand. If you're in a certain product area, you'll have certain things that make more sense for you.
Yeah. All right. So the future, are you seeing any optimism in the data for performance of consumer assets right now? Like, where are we in the cycle? I know you mentioned earlier that now would be a good time to start kind of getting back in. Um, what are you seeing in the data in terms of, the next twelve months?
I do see that the low point appears to be behind us in most product categories. Um, and so I'm increasingly optimistic on loan quality as we go through the year. I mentioned this caveat about mortgage. Um, it's clear that in mortgage, consumers are extremely rate sensitive, more so than any of the other products, which is a little anomalous. If you really sit back and think, if I was just running the finances of a borrower, um, the price of the home matters more than the interest rate because you can refi later to lower the interest rate. Consumers should be focused on change in home prices and looking for the buying opportunity. But consumers are not financially rational machines. And so it's very clear they key off changes in interest rates. So, yeah, what you can see that mortgage demand is still very low. So we're sitting that one out still, but
And how
they'll
will
come
that
around.
impact unsecured consumer?
Well, unsecured, I think, has already turned.
Yeah.
Again, not necessarily back to whole, but especially if the economy is a little stressed, it's more opportunity to verify the consumer. So in originating new loans, you may have some additional levers. And I always say focus on the segmentation. Try to identify those consumers who are lower risk today, not just focused on the bureau score.
Yep. Well, I like finishing on an optimistic note. Joe, thank you so much for being our first guest, and to all of our listeners. If you have enjoyed our podcast, please feel free to submit your ideas for future guests and topics to investor@upgrade.com or email us to find out more about Upgrade. This was your host, Jeff Bogan. Till next time.
Thanks for listening to Consumer Lending Perspectives. Subscribe for more expert insights and strategies from finance leaders. And share the show with your network. Until next time, stay ahead in the ever-evolving world of consumer finance.